you do an awful lot of research.
Yes.
But how do you identify shares worth looking at? How do you choose the good ones? You know.
As a global investor, you seem to have almost a limitless choice. And I would describe that initial search phase as slightly anarchic. Because if you go in with too fixed a view, saying, okay, I'm going to do some filtering based on macroeconomics or some analytical criteria, that may work for some people. And I like that rumbling around in the background, pushing up interesting macroeconomic themes or numbers that to kind of look for. But actually what I like to do is typically, if I'm looking at something afresh, is look at the primary information first. What's the primary information I would look at first? And that would be corporate results, the corporate website, corporate presentations and the like. And what you're doing is, what are those 6 key points and a couple of charts which effectively talk about this company and summarize it best for you, and then saying, well, actually, when I do a few numbers analysis and think about it in the wider scheme of things, in the macroeconomic backdrop we've got today, is there an anomaly there to look for? So my typical starting point would be the corporate results season. And then really, as you accrue experience over the years, guess what? You've seen lots of corporate results season. You have noted down interesting share prices for different companies, and that gives you a wonderful database to work from. So actually what I find today is that as a consequence of too many years of looking at things, I've got a wonderful database of interesting share price levels for companies around the world that I've looked at. And when one of those pings, that becomes of particular importance and interest. The critical thing though is not just to stick with that historic database, but to keep your mind open for new opportunities. And sometimes when I have time, is literally you have a company reporting on a particular day, there's not too many other compelling or interesting things at the margin in the markets that day. Why not just take a look at it for an hour or so, put together those 6 key points and a couple of charts which summarize that company well, and try and work out whether there is an anomaly or not. And actually some of my best investments, some of the investments I'm most excited about, have come from that constant search process. So really you've got to be part detective, part analytical filterer, and really the key of it is just to be interested. If you're interested and keep on working at it, something will come out of it and you'll find some anomaly which works for you, and then go out and proceed and invest in it.
Do you make use of shorting?
Yes. Shorting is an important side of any absolute return strategy, and even though I typically would make more long investments than short investments, there are times when the macroeconomic backdrop is mixed enough where you are fearful of generalized market declines or other forms of volatility, and where shorting or other risk control measures come in. So as an investor who predominantly is equity centered, what I would look is for specific short opportunities within companies, i.e. things looking the reverse of what I would look for in a long investment. So instead of some anomaly which would allow the shares to be re-rated, something which would allow the shares to be de-rated would kick in. So that would be for company-specific shorts. But really, on the shorting side, I would typically access 3 different types of instrument. One would be market shorts, so where I'm perhaps fearful based on my appraisal of big picture stuff, corporate earnings trends, macroeconomic backdrops, investor sentiment, for example. I would use things like index shorts. I think they're quite useful to balance up with individual company longs that you like, give you a bit of natural protection. Additionally, areas such as volatility trading is important, and instruments like the VIX, which is an indication of market volatility, I found over the last few years can be wonderful investments to help hedge against generalized market turmoil. So again, I would use VIX investment, long VIX investments in order to help balance out my portfolio exposures. And additionally, other asset classes, things like foreign exchange, which I use as well, again can give you uncorrelated returns with the equity markets. So again, when you're a bit fearful of the equity markets, you don't want to be overly exposed to them, sometimes you can access thoughts and themes and exposures best through other asset classes, with foreign exchange being the one I prefer to use. So if you had to summarise my investment approach, it would be working off primary investment sources, corporate earnings releases and the like, and then working that with macroeconomic trends and observations of share price moves or other investment pricing moves to kind of come to some overall conclusion. So by definition, you start off with that primary research input. And so what I find is everything gets split down into quarters. You have the corporate quarterly earnings round. So typically what you get is, let's take the January to March quarter. You start getting corporate earnings out in mid-January, and it's very heavy news flow up until about the end of February. So there's 6 weeks of the quarter when you're very on in terms of news flow and insights and inputs. That's a very busy time, but it's a very exciting time as well, because you can get lots of opportunities. You need to react to events. I often find that that's the point where I'm either establishing new positions because an anomaly has occurred because of that news flow, or I'm closing positions because price targets have been reached, or maybe something has changed. Again, as a consequence of that news flow influencing markets. So then you think about the other 6 weeks of the quarter. That's the, broadly speaking, earnings off period where you have less natural flow of that primary insights. And that's the period I would use more for longer term thematic thinking about the bigger picture world, macroeconomics, economic trends and the like, and also using the time to go back and look at companies which perhaps I didn't get a chance to look at, or where there have been share price moves where actually they're flagging there could be something interesting happening here. Either they've gone down too much or gone up too much based on historic ranges that I've observed. So that's how the quarter splits out for me, and guess what? All 4 quarters are the same. So it's a constant rolling basis. As I said, this is why passion is so important for investors, because it's a constant moving escalator. You can try and get off, and certainly during the off period, the 6 weeks where there's not so much of a primary corporate flow, that's the chance for a little bit more of downtime, or perhaps just to move away from the screens or the new information inputs. But if I can't think of the last day that I didn't spend a good number of hours looking at market-related stuff and information. It's a wonderful passion. I love it, and I think you need to have that, at least if you're going to invest in the style that I am. But yes, it's a wonderful but busy world.
What about companies that are tipping towards the FTSE 100? Is it a good, are they good investments?
I find that actually more interesting are companies dropping out of the FTSE 100, because it's back to whether you're more of a mean reversion investor or a momentum investor. And whilst I have a lot of, I find momentum investing intellectually interesting, I'm much more inherently a mean reversion investor. So therefore, companies that are dropping out of the FTSE, where perhaps people have got worried for some reason, the share prices have dropped, and hence the market cap is insufficient for them to stay in the FTSE, actually are a bit more interesting to me. For companies joining the FTSE, as I say, you've got to have a slightly more momentum hat on, and you may find that they're the next big thing, and consequently they'll join the FTSE, and over the next 2 or 3 years will rise up its ranks to be part of the top 30 or 50 companies in the index. And clearly, by definition, that's probably going to be a company to invest in. But intellectually, I find things dropping out of indices more interesting, particularly where you get that anomaly where there's a shorter term issue which has induced that, but actually the medium term fundamentals are still there. And what will happen then is the share will bounce back, it will probably re-enter the FTSE or the other index, whatever index you're talking about, and that creates a great investment opportunity. So I'm not a natural contrarian, but I have a bit of faith and insight in that. And certainly I'd much prefer it between running in the same direction as everybody or running in a different direction. I would always prefer the latter if you had to make me choose between the two.